Hey, everyone. So I'm John Chang, and I've been in the industry for 20 something years. And most of that time, I've been a commercial real estate investor. I'm currently running the research division of Marcus Millichap. And welcome to the Horizon. So this week, I have a good partner here and co-host, Matt Faircloth, a good friend of mine. We're kind of launching something new here with Fireside Chats where we're just going to start digging in and, honestly, I don't know where this is going, but it will be interesting. I can pretty much guarantee that.
This is going to be the best, man. Best ever listeners. I convinced John to do this with me, kind of on a very light script. Because for those of you guys that know me, that's how I am. I'm just a build a parachute. I'm just jump out of the airplane and I'll weave the parachute from raw materials before I hit the ground. Just give me a needle and thread, and I'll make a parachute as I'm falling. That's just how I am. So excited for this Fireside Chat episode. John and I have a few topics and a few questions to throw at each other, but don't have a script, no agenda. We're going to just get on and chat by the fireside. So imagine yourself, best ever listeners, sitting by a campfire with me and John, with a nice cup of coffee or a cup of something else in your hand, enjoying me and John talk shop about the real estate industry. So let's get going, man. John, do you want to kick off the first topic, or you want me? You want? I wish we had like a roulette wheel. Like it just
just spin it. You know what? Actually, why don't you go ahead and frame this up? Because there's so much happening right now. And based on where we launch this, we'll figure out where to go from there.
Oh, you want me to kick that? You want me to kick it off?
Yeah, you kick it off.
Okay, cool. All right. So John and I are both 20-year vets. We both got our battle scars and that. So the intention, guys, is for you to hear two guys that have been around the shop for a good bit talk shop, right? Okay, John, when you're looking at the economy, okay, I listen to the Horizon on the Best Ever network, and all you Best Ever listeners ought to listen to it as well, because John really whips out his crystal ball, and it makes sense, right? But here's the thing, John. There's too many factors in the world for you to there's just too many levers, too many points of data. There must be call it John's cheat sheet, right? Or call it KPIs, to quote traction, key performance indicators. What three things matter the most in predicting an economic cycle, like looking at where things are going? When you look at an economic cycle, I'm sure there's the noise and there's data points you can grab out of the noise, but then there's probably 2, 3, 4 things that are above the noise. And if you see them going one way, it's like, okay, this means that this is what's going to happen or whatever. What are those things and why are they so important?
Wow. Okay. That's a great place to start. You loaded that one up. Okay, so when I'm looking at commercial real estate markets, there's really a few core drivers. And honestly, every market is different. So you can have one market going one direction, another market going another direction. But in general, what I'm looking at first and foremost is what's happening with employment. Okay. And we recently just got some new employment numbers for July. They're weak. And so my shop, my Marcus Millichap research team is actually in the office. They're scrambling to recalibrate all of our forecasts based on new job numbers. That's probably the first and foremost thing I'm monitoring is employment. The next thing is demographics. And again, you can have overall population growth or declining population, and in any given market, it's different. For example, you look at Dallas, and they've had huge population growth compared to, say, Chicago. And that's the other big component where you're seeing the flow of people moving from one place to another. The third big thing, and this is different from the economics, but it's the supply in the local market. What's happening with new supply? So we saw that with Austin, for example. At one point, they were adding about 12% to their inventory in multifamily. And so they got out over their skis, and it really overwhelmed the market. We've seen rent rates drop for multifamily. in Austin because they built so much. Now it's a growth market and it will absorb that over time. But that's one of the things that you need to really monitor. It's the supply side of the equation. And looking forward right now, you start rolling in all the other economic factors, things like the tariffs and how that's going to affect construction as we go forward. You start looking at labor supply with the more stringent immigration, and you say, okay, labor supply for construction, which is officially about 35% non-native born people, probably unofficially more close to 50-60% when you factor in undocumented workers. So you start to look forward and you say, okay, well, if material costs are going to go up and labor costs are going to go up, then and the cost of capital for construction is north of 8%, then construction is going to slow down for everything. So that's your supply dimension. On the other side, you have your demand, which is jobs and population growth. And that's going to affect every type of commercial real estate out there. So those are the big things that I'm always monitoring at any given point. And then there's all the rest of the stuff that's coming in. Retail sales. I watch ISM manufacturing and non-manufacturing and just a lot of these other indicators that are popping up.
Questions. Why in your top three was not interest rate? Is our interest rates, is that like a tail wagging the dog, right? Because interest rates tend to follow along, as I understand in my little layman's peon brain over here, I see employment. Like you said, employment came in a little bit weak. Conveniently, those numbers came in after the Fed had made their decision to not raise rates, right? So at the end of the day, it seems like things like employment and inflation tend to drive interest rates, right? Not the other way around. And other economic factors like investor sentiment towards bonds and that kind of jazz, that's what drives bond prices and whatnot. So do you believe that interest rates are a key factor, or are they, is that a like secondary factor that is just a result of other key drivers?
So that's where we parse over. So, on one hand, I was talking about the fundamentals, really. What's going to drive vacancy and rent growth and that type of thing. This is the other side of the equation, looking at it from an investor standpoint, and that's the impact of the interest rates. And those are going to be driven partially by the Federal Reserve, but also by market forces, right? What's happening in the stock market, what's happening with people who invest in bonds, Japan, China, the Federal Reserve, how much treasury issuance there is. And the effect of the the interest rates is going to be on whether or not the deal pencils. So as an investor, first of all, you're looking, okay, what are the markets that are going to behave well? What are the ones where I like the outlook for the performance of the property? Then you say, okay, what does the deal cost there? What's the cap rate? What's the yield on these assets? And then you start rolling into, okay, what's my debt capital going to cost? That's my interest rates. So interest rates are important once you start getting into your underwriting and start trying to figure out, hey, can I buy this thing? What's my debt going to run? The new tax reform is another piece, that's out there with the, with the bonus depreciation, that if it's a deal that's marginal, if it's close to making sense, that bonus depreciation could, tip it over. So interest rates, there's just so many things. But Matt, I'm going to put it back at you. What are you looking at? See, you're out there making the investments. I'm just sitting here and trying to figure out what's going on.
Right. Yeah, you're just a hippie on the hill, right?
That's right.
Like, hey, man, well, this is what I think.
There you go. There's my 2 cents.
Okay, cool. Yeah, turn it around on me, brother. Yeah, turn it around on me. What are you asking?
What are you looking at? What's most important and relevant to you as an investor? Because I know you have many facets of your business, but strictly as an investor, when you're going out trying to figure out, what do I buy? What do I sell? What am I going to do? Where am I going to go? What are you looking at?
Oh, sure. Good. Okay. So my factors are, when I look at an asset class or a deal, I look at scalability, right? And that's not even the first one. The first one is investor yield, right? Can I sell this deal? Are my investors going to get excited about this deal? Is there a level of security for investor capital. They put $1 in. Is that capital well secured, and is that capital likely to grow? And what is the likelihood that it's going to grow? In a secured fashion, right? So investor yield. When I look at a deal, and it used to be like before, like pre-COVID, and even like 21, 22. Appreciation with low interest rates and low cap rates, appreciation was the game. We are now as a company looking more at cash flow. If I'm looking at a deal that doesn't cash flow day one, now we've done some development deals, which are obviously not going to cash flow day one, but they better cash flow like right after the paint finishes drying, so to speak, right? And so we want to see early stage cash flow in deals. And so if I don't see that, no more of these deals that don't cash flow for 2-3 years. We've done plenty of those, and we're unwinding a lot of those now, man, because that you were able to make that game worked in 2015, 16, 17, where we had one property, John, we bought it for $6 million and sold it for $16 million. Didn't make any distributions the whole time because we just did a ginormous value add, tore the whole place apart and put it back together. That deal would not fly in today's marketplace. You're not going to be able to raise equity on something like that, nor would I want to take the risk of something like that. That deal worked great for us, great for our investors, but we're in a different time now. So I look for early stage cash flow first and foremost, and growth. Then I look for scalability. So if I'm doing a deal in a market, geographic market, and an asset class, like I'm buying 2 hotels right now, I want to see a path that I could 10x that. Is there a likelihood, maybe not a guarantee, but a likelihood that I could do 20 hotels in the next couple of years? There is, given the partners that we have and those kinds of things. So I look for, like I said, in investor benefits and scalability when I look at things. And then I honestly look to people like yourself for things that I can't control. Like, where are things going to go? Because there's a lot of prediction we have to do. Like, well, what's RevPAR growth going to look like in a hotel over the next couple of years? I don't know. I got to listen to the sages of the world that watch economic drivers more closely than I do, honestly. And I have to listen to their predictions, and I have to look at some historical data on what hotels did during times like COVID, or what multifamily did, and those kinds of things. So I'm seeing all that, and then I'm seeing the less affinity towards things that were cooler and sexier in the 2018, 19, 20 range, which are big value add deals, C-class. We can jump into the C-class pond if you want. But that's all. The C-class world is a place that's changed a lot over the last couple of years. And that's what I've witnessed. We are not doing any more C-class. I own quite a bit of it, but we are transitioning out of the C-class investment world for all the reasons that there are to do that. So
you said you're looking at your going in returns. Is that actually, you said you were looking for yield? Are you talking about going in yield? You want to have positive leverage going in on 100%. The deal?
So, yeah, and John, it's tough to do that if you got a multifamily that's trading at like 5.5, 6.5 cap, right? And if I'm borrowing debt at around that same number, if not more than that number, that you're not going to get positive yield to investors, positive cash flow. I think the investor today wants to see at least 7, if not 8%, yield early stage return on capital. Which, show me a multifamily deal that's doing that first day. You're just not. It's not out there. They're there. They're there in year 2, 3, whatever. And you're certainly, because of low cap rates, going to see high appreciation. Because if I just go and squeeze $15 a unit out of my multifamily property, and it's trading at a 5.5 or a 6 cap, then I just up the value quite a bit because of forced appreciation. But it's very tough to make cash flow early in the asset. So I feel like the investors that were there are less. The whole reason for all of this, John, of being cash flow centric, is because I think that the world has gotten more risk sensitive overall. The overall sentiment from investment is way less bull, a lot more bear, because of all the things, because of COVID. There's COVID hangover going on. There's interest rate hangover going on. And so I think for all those things, people are looking for surefire bets. and I want to make a good return on my money. And yeah, you can promise me the sun, the moon, the stars that I can make 18 to 20% on this value add multifamily deal. But if you're not going to pay me anything, it kind of seems like a gamble.
So you're looking for the sure bet, and let me play devil's advocate with you here, because you're talking about going into hotels, right?
Bring it.
I haven't boned up on my hospitality data recently. I just kind of in the periphery a little bit. But what I haven't seen is occupancy rates have been going down. RevPAR has been going down. A lot of that is being attributed to foreign travel and kind of the repercussions of the trade wars that we're playing with right now. And then you start looking at
discretionary income is decreasing in the US. Yeah.
And then you also have your labor costs, which are going to really hit the hospitality sector. A big portion, I think it's about 35% of the labor force is non-native. In other words, immigration dependent, and with more stringent immigration enforcement, labor costs for just running the hotel are going to go up. They already got beat up pretty bad by COVID, and a lot of hotels really haven't gotten back to pre-COVID staffing levels yet. So I look at hotels and I go, gosh, that's a tough one. How do you make that work? I guess that it's trading at a higher yield, and so it may look appetizing from that standpoint. But what's in your head?
Let's do it. Yeah, I love that. Thank you. Great question. So you can't put, just as you can't put all, like, there is a hospitality asset class, right? And so that includes properties, that are maybe a little more bougie, like the Four Seasons and the JW Marriotts and that kind of stuff, right?
Luxury segment, yeah.
Yeah. Those but those are in the same bucket, or considered to be in the same hospitality, overall asset class as you would consider a Super 8 or a mid-tier, what I would call a limited service,
right?
Hampton Inn Express, Holiday Inn Express, Hampton Inn and Suites, Home2, those kinds of assets, right? So here's the discrepancy, right? The higher end assets, so let's just say they're newer build that are charging, $300, $400, $500, $600 a night, whatever. We've all stayed in them, right? Probably when you go to a bougie conference or something like that, right? Those assets are certainly seeing decrease in RevPAR, decrease in revenue, decrease in occupancy and everything like that because of, as you said, overseas travel. Why do you go to a hotel like that? Number one, conference. Number two, because you want to go and use some of your discretionary income, some of your extra money to go travel the world, go stay in a cool hotel in a cool location, right. So those assets are declining. You are right. Right? The low end assets are declining too, because there's not that big of a jump. Why stay at a Super 8 or a Ramada Inn when for an extra $20, you can go to a Hampton Inn Express where you get free breakfast and it's clean and a nice hotel, a nice, gym or whatever it is, right? So there's a spectrum of hospitality.
Right.
Okay. The mid-tier hotels are the ones that are seeing an increase because people are pulling back to the mid-tier, right? And people that have to go business travel, like they have to for conferences or for traveling sales reps or whatever it is. One of the properties we're buying is in Houston. Houston has a ginormous amount of traveling consultants that go pop into the Halliburton corporate headquarters that are down there, and all the oil and gas stuff that's going on in Houston. Lots of traveling consultants that are road warriors, living out of a suitcase Monday through Thursday, staying in a Hampton Inn Express or whatever it is. Those folks need to stay in assets like that regardless. Airbnb is not robbing a lot of inventory, stays away from those kinds of, as people thought that they would. It's not, right? Because you get the free breakfast, you get the gym, you got all those things, right? So those assets are continuing to stay strong. Now, a few other responses to other things you said. COVID, if you look at the data, the high tier assets and the low tier assets got their teeth kicked in during COVID, but the mid tier assets got propped up because of the PPP loan, right? PPP loans, a large percentage of PPPs went into the hospitality sector because of the amount of people that they employ. Okay. Now, one thing that you're absolutely 100% right about, but it's not just limited to hotels, is the factor about migrant workers, right? It's all good. It's a good pulpit to stand on to say, well, we shouldn't have all these illegals take, right. Here's the thing. The American economy depends on folks like that, right? Not just in hospitality. Everything from the breakfast that you and I had this morning was likely touched the hands of a migrant worker, as did the construction fields, as did a lot of different things. You can't take however many million people we're talking about and throw them all out of the country, right? Maybe those that broke the law ought to go. And I'm not getting into politics or anything like that, but you are certainly not. There are too many people that the American economy depends on, folks and the folks that clean your room through hospitality, to remove all of them. There is certainly pressure on folks like that because of all the stuff coming down. But I don't think that you're going to take that labor force away completely in that. So that's my long-winded response about why certain types of hospitality, limited service hotels, and more importantly, with brands, is one more comment I want to make. I am not somebody that's going to go buy in a roadside motel and turn it into some cool boutique hotel or whatever. I know lots of Instagram influencers are doing that. That's cool. Great for photo shoots. Show me somebody that's going to buy that asset, right?
Right.
You can't trade it up to anybody. It's cool while you're doing it. It's a cool reno, but no one is going to go and buy a roadside motel turned into a boutique hotel as a trade up investment. I can find someone easily to buy my Hampton Inn or my home to, because it's backed by $1 billion company, Hilton, right?
Yeah.
So I believe deeply in buying branded assets and dealing with the pain in the ass that it is to deal with Hilton and the pips they make you do and everything like that. I believe in that because I've got something that's backed by $1 billion company that a larger corporation would want to buy.
So you're talking about flagged limited service hotels and that they're going to be sustainable. And again,
that's my story and sticking to it, John. Well, flagged limited service hotels are,
especially in when you consider the construction is going to stall out. At least that's my belief. Then those hotels that are already there and established could do well. I've heard that business travel is still actually increasing or stable. That segment of the client base is there. Leisure travel is down, but again, I think the lowest income levels are being impacted the most, and so and they're not staying there. And your upper income are impacted the least. But they are also becoming increasingly cautious with lower consumer confidence and sentiment levels that we've been seeing. So, okay, I can see your thesis, but man, it's going to get down to property specific. It's really about the details and understanding that property at that location, who's staying there, and why.
It's 100% property specific, man. We've been trying to get into the limited service hotel business for the last year and a half as a company. And it took us that long to find deals, right? Because a lot of deals were trading at too low of a cap rate, or a lot of deals were in a dicey location, or, because we've all stayed at a Hampton Inn and Suites. It was in the wrong side of the tracks, right? It's a fact that is true. They're not all in great locations. And all of them don't get the best RevPAR or the best occupancies in the world, right? So you got to find the needle in the haystack. And it also goes back to operations. Who's going to manage it for you? I can tell you, we own the management company that runs our multifamily, John, but no way on God's green earth am I going to own the management company that runs a hotel, because a 100-unit apartment building might have 2, maybe 3 employees full time. A 100-key hotel, because that's, you got to learn the lingo, John. You say keys, you talk about hotels, you can't talk about doors anymore. Now you talk about keys, right? So a 100-key hotel has somewhere between 20 to 25 employees. Oh my goodness.
Whole different ball game.
Oh boy. Yeah.
And plus you're interacting with the platform from the brand, right? So you're connecting into the Hilton system or the Marriott system, and really have to be able to use that. There are really good professional management companies out there in the hotel space.
transitioning. Let me curveball you in the couple minutes we got left. Okay, give me one in you watching the economy, being a investor, and all the things that you've done in the last 20 years. Give me like one or two anecdotes of the biggest times the economy surprised you. You thought it was going to zig, and it darn went and zagged on you. Right. So give me those. Give me what happened looking back, because I know you guys economists aren't right all the time. It's all good. I bet you're right like 99.99% of the time. But give me that 0.01.
All right. Well, I mean, there's a lot, right? So I remember I'm teasing. In February 2020, I was at a conference. I was talking to some people. They said, "So, what do you think about this COVID virus thing?" And I was like, "Oh no, it's not a problem. It's no big deal. It's not going to have any big effect. It'll come. It's like the flu. It'll go away, and it'll be fine." Which ultimately,
it was not the first virus to come out of China. If you look at like SARS and E. coli and all these other things that came, what was it, swine flu that came and went, mad cow disease. I'll keep making the list of all these things that had came and gone, and they were the headlines for a month. And I think we all thought COVID was going to be one of those just headlines.
Exactly.
Little sizzle in the pan, and then it's gone. Right.
Yep. Back in 08, was it 08 or 09? It was 09. We were writing all of the Marcus Millichap investment forecast books for the coming year. It was October. We were just finishing up our apartment report. It was at the printer when Lehman Brothers went down. And I literally, that day, I called the printing company and I said, literally, "Hey, stop the presses, throw it all away." We had to rewrite all of our books. We had to redo all of our forecasts, recalibrate everything because the world changed that day. And so, sometimes I'm looking forward and I'm looking at some of these metrics and I'm thinking, gosh, one of them, here we are. I'm looking at interest rates.
What was that? You missed tell me again that story. Are you talking about the going into the great financial crisis?
Yeah, into the financial crisis, Lehman Brothers collapse. That was the trigger point where the entire economy dumped. The capital markets froze up, and all of our forecasts that we had just written were thrown away. And we went back and redid everything because everything was different. Yeah. One point, a single point in time, everything changed.
And nobody saw that coming down Broadway.
Well, we saw it. We thought it, at that point we were thinking, okay, this is going to be a recession. We're going into a recession. It's going to be limited. It's going to be relatively mild, kind of an 01 recession kind of thing. But when Lehman went under, and a lot of that was being held close to the vest in the financial markets, you kind of hear about it. You kind of know about it. You know that the housing market was inflated. You saw a lot of the warning signs, but my belief at the time was that it was going to ripple and it was going to cause some problems, but it wasn't going to be a freaking global financial crisis that was a great recession that caused everything to stall out completely. It was going to be a moderate softening of the economy where everything just slows down, and then we'd move on and it would get better.
Yeah, but it wasn't public knowledge that Lehman was in such financial distress at the time, right? Like that
I don't think so.
That they were teetering.
We weren't tracking it. We didn't see it.
Yeah. I was just getting going as a real estate investor at that time. So, I mean, I was not even tracking any of that. I just turned on my TV one day and it's like, oh, the shit just hit the fan, everybody.
Well, I mean, if you look back at the photos or the videos of the people who were working at Lehman, they didn't know. They're sitting on the sidewalk with a box full of their stuff crying, and they didn't know. How am I supposed to know? I'm in Phoenix.
Right. But it didn't seem like anybody. It seemed like such a great surprise. I've seen that movie, The Big Short, about it, and they weren't even talking about Lehman. They were just talking about shorting all these mortgage-backed securities that were out there.
Yeah.
So that was a gut punch, and then COVID, of course, like I said, nobody in the world. I know we all saw it coming globally, right? Like, oh, hey, here this thing comes. But I think nobody thought that it was going to be as serious as it was, or that it was going to shut the world down the way that it did, right? So Cool. Yeah, I figured those would be the two, but I was curious to get your economic.
Those are the low-hanging fruit. Right now I'm forecasting interest rates will go up because I believe the Treasury issuance is going to push up the rates. But here we are, halfway through the year. Rates, they really haven't gone up. They're 4.25% right now. I mean, they're bouncy, somewhere between 4.25%, 4.5%. They haven't gone up yet. So I could be wrong on that. But
I hope you are, brother. Uncle, man. It's like a surrender flag. Like, God bless, please no more. Good night. I gotta tell you, man, we're getting to the 30-minute mark here. I want to throw this out to the best ever listeners. Here's the deal. Me and John are going to record more of these fireside chats. So if you want to hear me quiz John about really, really why he really thinks interest rates are going to go where they're going to go, please don't. But I'd love to hear why. Holy crap, please don't let them go. Why? But I want to know, I'm going to tease you guys a few questions, right? About rates. I also want to know what John thinks about rent growth. Right. I also want to know what John thinks about C-class versus new construction, because he's over here talking about supply. Building new apartment buildings has nothing to do with the 1970 vintage apartment building that's right around the corner from it. How do those two correlate? I want to know. And if you want to know too, tune in to another Fireside Chat with me and John. That's my tease of the day. And if you guys want to hear more from me and John, from all the other best ever hosts that are here on the Best Ever Show, what are you guys doing? Push there's a subscribe button here on your podcast app. Hit that button. Come check out me and John. John broadcasts on Sundays. That's when On the Horizon comes out. And you can hear me talk shop with a lot of my real estate buddies in the Next Level CRE show on Fridays, and all the other hosts that we have. There's no other reason to listen to any other show. We've got all these other diverse hosts that are out here. Cancel all your subscriptions to all your other shows you guys listen to. Just listen to the Best Ever CRE show every day, and we'll give you guys different new conversations coming at you, including these Fireside Chats. Until then, John, what do you think, man? Let's get it.
I love it. This is good fun.
Yeah, this is fun. All right, we'll see you guys in the next Fireside, all right? Have the best ever day, everybody.